What's up, everyone? All right, so in this episode, I'm going to walk you through the reverse split setup. This is a setup that I've been aware of for a very long time, and it's based on a stock that has very recently had a reverse split and then looking for that curl and squeeze back up. This generally is only a setup that you'll see on stocks that have pretty ugly daily charts. They've been beaten up for a long time, and some stocks have a history of doing multiple reverse splits. And I'll talk about exactly what a reverse split is. But we'll just look at this chart here first, for instance. So this stock here did a reverse split on Friday. The stock puts in probably the biggest green candle it's ever had. The previous reverse split was a few years ago back here, and the stock following that reverse split also curled back up and made a pretty big move, relatively speaking, for that time. Here's another one that just recently did a reverse split, DBGI. And you can see this chart is like horrendous. I mean, the stock has just been selling off and selling off. So you've got the yellow reverse split right there marked on the chart. And it went up almost 300% following that split. Okay, so why do these charts look so terrible? Well, what happens when a company does an initial public offering, they sell shares onto the open market, right? So the reason they do that is because they want to take that money and reinvest in the company and help the company grow. And all the shareholders that buy those shares, and of course, when they buy it, that money goes to the company, they get to benefit from the future growth. And so in a case of like a McDonald's, a company that's able to grow just tremendously over decades, all the shareholders benefit from that growth. But on the other hand, that's a success story. But what is very common in the market, especially with small companies, is that they'll do their IPO, they sell shares onto the open market, and for whatever reason, they're not able to really generate substantial profits. This is very common with pharmaceutical companies, biotech companies that are working on research and development, and they're hoping they come up with some invention or some new medicine that is, they can sell to, and then either the whole company gets bought out by like a Pfizer or whatever, or that they can license and do really well on. But during the whole R&D phase, they're just burning cash. They're losing money. And so the people that invest in that type of company are people that believe in what they're doing. Okay, but after a couple of years of running the business and losing money, the share price will generally just be declining until it gets to a point where it's actually going below $1 a share. And that's where reverse splits come in. To have your stock listed or your company listed on the NASDAQ or New York Stock Exchange, there's a minimum listing requirement of maintaining $1 a share as a minimum price. Now, a stock can drop below $1 a share, as we'll sometimes see, and they have a period of time to regain compliance and get their stock back up over $1. Now, the one way to do it, of course, would be to have that very successful drug come out or a great invention, or to just have the business make more money. But short of that, the mechanism that they can do is a stock split. And rather than a traditional stock split, like what you may have seen with Apple or Tesla, they do a reverse split. So in a traditional split, if you're holding 1,000 shares of Apple at $700 a share, so $700 a share, I'll just use this as a drawing board, $700 a share times 1,000 shares, 1K shares, that would be $700,000 in the stock. So if Apple does a 7-to-1 reverse split, on the next day, the stock will open at $100 a share. And you might think, oh my goodness, I'm down big. And then you'll realize that your cost basis has gone from 700 down to 100. So you now own at the same price. Well, wait a second. And you went from having 1,000 shares to having 7,000 shares. So when a traditional split occurs, the number of shares outstanding goes up by the multiple of the split. All right. And the price goes down. In a reverse split, it's the opposite. The price goes up and the number of shares goes down. So inversely, if we have a 50-cent stock and you own 10,000 shares of it at 50 cents, on the next day they do a 10-to-1 split, it's going to start trading at $5 even, right? $5. Sorry, my drawing's not great. $5. And you're going to realize you only hold 1,000 shares. So a reverse split effectively should not result in the stock just by itself going up or going down. It's almost like trading a $100 bill for 20s. It's just a trade. That's really all it is. But we've noticed a pattern. And so the pattern is where the setup comes from. So here's the pattern. There's a lot of small cap companies that go into this cycle of doing reverse splits. So the company initially IPOs, it sells off, it goes below $1. They do a 10-to-1 reverse split. And what might have been initially the number of shares outstanding, let's say they sold during their IPO 10 million shares. And they sold them at $10 a share and they raised $100 million. And that gave them 5 years of cash flow. But now that cash is gone, they need to raise more money. So as the stock declines, it goes down to $1 a share, let's just say. Let's just say $1 a share. So now they do another reverse split, 10-to-1. Okay, so the next day the stock is going to be trading at $10 a share. But the number of shares outstanding goes down by the multiple of the split. So you go from a 10 million float to a 1 million float. All right, now the stock's back at $10. That's great. What would be really, really good is if in the next couple of weeks, the company puts out some good news, because now traders are going to recognize, well, this isn't a penny stock, it's a $10 stock. It's coming off the lows, right? It's moved back up here to 10. And so it's very common to see this cycle of reverse split. Some good news comes out and then a secondary offering. The secondary offering. So good news comes out, and then what happens is the company will start, the share price will start to move up as they're putting this good news out, and into that volume, into that liquidity, they'll sell more shares. So now let's say they're able to sell 10 million shares at $10. They're going to raise another 100 million in the secondary offering. So reverse splits, and there's no guarantee. I mean, listen, a lot of companies have shelf registrations and don't exercise them and don't do a secondary offering. A lot of companies have reverse splits and don't do a secondary offering afterwards. They're not always combined, but we do see it a lot. So I have a few examples of this pattern that we've seen recently. So DBGI is one of them. So this is a stock that does a reverse split right here. And you know what's really interesting is it had a tremendous amount of volume before the split. That always to me is a little bit of a red flag. I'm like, what's with all this volume before the split? It's a little weird. They do the split, the stock sells off a little bit, and then it starts to squeeze back up. And so between this day here with a low of about the low was 321, it goes up to a high of almost $10 a share. It's like 300%. That's a huge move, 200%. It's a big move from $3 up to $10. And then what ends up happening is secondary offering. So let's see. And by the way, this is the reverse split setup. I mean, we've just seen this again and again and again. I have a chapter of my class, Day Trading Strategies and Scaling, where I just show you all these examples of reverse splits. So I'll just make this a little bit bigger. So this is another example of reverse split. Stock goes from $6.37 up to $19.68. Another example here, reverse split and a squeeze up the next day. Reverse split, recent reverse split starts to move up the next couple of weeks later, goes from 4 to 26. Another reverse split here from 4 to 60. That was crazy. Another reverse split here, almost same day. Crazy move. So one of the reasons that the stocks are able to put in such big green candles following the reverse split, it's because the float is a fraction of what it was before. So the supply-demand equation has changed. The level of supply has decreased dramatically. So now if they put out some good news, even a little bit of demand, a medium amount of demand, can create this imbalance where you see these 100, 200, 300% moves in the stock. And then that's when you have that big move and you've got that liquidity, that's the opportunity to do a secondary offering. So on DBGI, for instance, let's see. All right, so we'll look at DBGI. So DBGI, we have they announced a secondary offering, and they had a shelf registration. All right, so this was their shelf registration that gave them the right to sell shares on the open market. It would say how much money they had given themselves the ability to raise. And the reason a company will file an S3 or a shelf registration is because they have to notify shareholders of their ability or a possible intention to do a secondary offering, because when they do it, if it gets announced, it's diluting the value for all the other shareholders, right? If they originally had a 1 million share float and then they sell 10 million shares in a secondary offering, it's diluting your value big time. So the S3 shelf registration, you can look at it and you can always check to see if a company has one. They're good for 3 years. So you'd have to look 3 years back from today's date to see whether or not they have one and it's valid. And then you could look in the filings to see whether or not they've tapped into it at all. And they can tap into it in multiple sort of increments. This is, $10 million here, but the shelf might have been for like 50 million or 100 million. Sometimes they're for huge amounts. Okay, so let's look first. Let's look back at a couple of more of these reverse splits, and then we'll talk about the secondary offerings in a little bit more detail. So there's another reverse split example. This is a stock that has a reverse split. It sells off. It goes from about $8 up to like $15 a share. That's almost 100%, and it was in a very short period of time. So one of the things that I always encourage traders to be aware of are not just your intraday setups where you're buying and selling. Of course, you have to know about your pullbacks, your dip trades, your moving averages, your ABCD patterns, things like that. But you also have to be thinking about the daily setup of the stock. And so a daily setup could be a daily chart pattern, but then there's other characteristics that can increase the potential that the stock could make a bigger move. And I found that recent reverse splits, in addition to recent IPOs, blue sky setups, SPAC mergers, these are all the type of I don't know, it's a stock type, so to speak, that then any setup I see on it, I'm a little bit more interested in, or I think has a little bit more potential because of that sort of underlying factor that surrounds the stock. So just the reverse split by itself, a stock announcing they're doing a reverse split, to me, isn't enough to buy. I'm not going to look at every stock that's announcing a reverse split and just blindly buy it because they're announcing a split. There's a lot of times, like in the case of DBGI, where they'll announce a split and then kind of nothing happens for a period, or worse, the stock actually drops quite a bit. It actually dropped following the split, and I'm not really sure why exactly, but it sold off more after the split. Maybe there was some news out. So it's not a strategy for me just to buy a stock that's doing a reverse split, either just before it or the day of or the day after. But when I sit down each morning and I'm looking at my scanners, so, my morning routine pretty much is I sit down pretty early and I check my gap scanner. If I pull up one of these stocks that's at the top of the gap scanner and I see, oh, they have a reverse split, today or yesterday, now all of a sudden I recognize that stock has a little bit more potential. And of course, this one made a crazy move beyond what you normally see with a reverse split because of some other underlying factors that were involved in this particular stock. But in any case, when I see something like reverse split, it makes me think, okay, this has a little bit more potential, perhaps. But then the second part of it is the secondary offering. So in the last couple of weeks, well, maybe last like month or so, we've seen a handful of stocks that have put out great news, right? They have great news in the morning, and then either later that same day or the next day, boom, they're tapping that shelf registration and they're doing a secondary offering. And this feels super frustrating as a retail trader, because as a retail trader, we're looking for volatility, we're looking for liquidity, we're looking for stocks that are moving quickly. And so when we have a stock that's squeezing up 15, 20, 30, 40, 50%, that's awesome. If we end up getting one that goes up 100 or 200%, that's incredible. That doesn't happen, every day, but it's crazy when it does. So then when later that same day or the next day, the company says, hey, we just raised $10 million or whatever it is, doing a secondary offering, it feels like a little bit of a slap in the face. It feels like retail traders like me, we just bought right into it. And so there's different types of secondary offerings. There's a secondary offering where they're using one of these big institutions, an institutional firm, trading firm, to sell shares directly on the open market. And what's really interesting when this happens is that we can sometimes visualize it. And so what I've noticed on, I don't remember if it was DB, so DBGI did have that secondary offering. We can look at the 5-minute chart. I can't recall if this was one of them, but one of the things that I've seen has been where you start to see, what day was the offering? We start to see this these big sellers starting to line up on the ask. And so as the stock is moving higher, we're seeing 150, 200,000 share sellers on the ask. And you're like, who is selling this many shares? Is it someone who got in right before the news came out? Maybe. Is it someone who's trying to go short on the stock? Maybe. Is it the company themselves selling shares directly onto the market? Maybe. We don't really know until maybe later that day or the next day we see the news posted that they did a direct offering. Sometimes they're just one of the other scenarios, a big short seller or a long trader or investor that's trying to unwind a position. But one of the things that feels frustrating is that you get this headline of really good news, and then like right into that, as soon as you get the headline for good news, it's like right away they're already looking to raise money off of it. And I feel like that's a little bit frustrating. So just as a retail trader, it feels like it's just something that kind of keeps happening. So it happened on DBGI, it sells off, has this big move, and then secondary offering. We had, let's see, I think ICVX was one. So ICVX, this wasn't a recent reverse split. This was just a stock that had definitely been beaten up a lot, was down quite a lot. And if we look at their filings, so this was ICVX. ICVX, let's see, they've got a shelf registration, right? So this is a company that's got a shelf registration, gives them the right to sell. For some reason, this isn't loading properly. I think it was $400 million in stock. Let's see. $400 million in common stock. Now, when I saw this one squeezing up, I started to wonder, are we going to see a secondary offering out of them? The stock's just gone up from $4 to $16. They have a shelf registration. Are we going to see it? I don't know. So, you just you're watching the news and you're just waiting to see one of these days, are we going to see secondary offering price at the market or whatever it is? And one of the problems with these offerings is that if it's a direct offering, it'll be at the market. But if it's like a private placement where they do a deal with one of these big investment banks, then the investment bank wants a discount on the shares. So they might be like, well, listen, we'll give you $5 million, but we want the shares at a 40% discount of, the close. And so then the offering is announced and it's priced at, $5 a share when the stock was trading at $20 a share. Now, here's an example. Let's look at HUDI. So HUDI, this is a stock that had, it's a foreign stock. So they've got an F3, which is same, but it's for foreign. So this is a Chinese company, F3. So they've got their shelf registration. And this stock starts squeezing kind of like crazy. It makes a huge move. And it goes from like $15, $20 to an incredible $180 a share. Let me back it up on this one. This was absolutely insane. I mean, this chart's bonkers. It goes all the way up here to about $180, $190 a share. And then what ends up happening is on this day right here where you see it's all the way back down here, on that morning, they put out news that they were doing a secondary offering. And let's see, it was priced at $25 a share. And they announced it at a time the stock was trading at about 160. So what do you think happened as soon as that news was posted to the PR? Boom. Instant drop. In one candle, it drops from $120 to $40 a share. And as the day went on, this thing went, it literally had a high pre-market of, well, I don't know what the high was, but it was trading pre-market at around $140 and dropped all the way to $16 a share. That is massive. 90% loss of value in one day. So, this is bearish because the most an investor was willing to pay them was $25 a share. Let's see. So this was the offering that they did, a registered direct offering, right? Expected to close around November 9th. Consists of 1 million ordinary shares. This is the firm that's acting as the exclusive placement agent for this offering. So they're the ones that are going to be finding the buyers. And, you know, this ends up being it's just crazy. The stock goes from $108 a share to $16 in one day. Okay, so that was DBGI. Let's look at TOPS. Let's switch back to this here. All right, so we'll look at TOPS, TOPS. All right. TOPS, it's another stock that has an F3 shelf registration. It's a foreign company. All right, so it looks like they're out of Greece, Top Ships. Foreign company, they did a $13 million public offering right here. And let's look at this chart. You could probably guess around when the offering took place. So reverse split right here, showing on the chart. This was actually a little bit of a funny one. This whole chart is kind of a mess. If we back this up, let's see, it's gonna take a second to load. Look at all these splits. Split, 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 split. This is a company that has a history of doing this. And if you adjust the price of the stock, look at this. This is crazy. But they keep finding people that are willing to invest in the company. I mean, can you even imagine? Look at how expensive. So let's just say this was back in 2016. In 2016, if you bought, 100 shares, because of all the reverse splits, because every time the splits happen, the price goes up. So then the historical chart goes up by that same ratio. So here, I don't even have commas. Let's see. All right, so that would be 5 points. Oh, I just lost it. So right at there would be 4.6 million a share. That's 24 million a share. That's $324 million a share. Wow, that's crazy. So the float on this one as of today, let's see, it's certainly going to be lower. Let's see, it's a 10 million share float right now. So we've got 10 million shares outstanding as of today's date. So, as of today's date, and just recently we saw, and I'll just auto adjust this here. I'm going to have to take off my 200 moving average because it's breaking the chart. So we see how we got this big move, right? We got that big move there up to 11. It sells off, it comes back up, and this was on December 2nd. Let's see, what was the day that they announced their offering? It was the 14th right here, announced as a public offering. So that was, it was right after that candle. It was right after this one. My mistake. It was right here, right after this candle. So it sells off, it pops up. So on this day, it had a low of $1.50 and a high of, let's see, what was the range? It was a pretty good range on that day. Well, that was the day that we got the, announces the pricing. Let's see. There were some other transactions back here. So that was TOPS, another reverse split, and then secondary offering stock. ONCS, I think this was another one. ONCS. Shelf registration, let's see. S3 is back here. So it's about a year old, but it's still valid, right? So that's a shelf registration for $100 million. And then right here, we've got the news that they priced $3.5 million offering, about 1.1 million shares at $3 a share. Okay, so now let's look at the chart. That was on December 1st. So you have a reverse split. A few days later, the stock squeezes up. You have this really big move. It squeezes up here, ends up hitting a high of $6.50. It sells off, it comes back up. And then we get the news of the secondary offering. That was ONCS. We had DBGI, I already looked at that. TOPS, RNAZ, let me check this one. So as a momentum trader, my goal is to look for volatility and liquidity. I'm looking for stocks that are moving, but naturally I'm thinking about downside risk, and I do not want to get married to any of these stocks. I am just trading them. And I think it's really important that you're thinking about your downside risk on these. There's a recent shelf registration there on RNAZ. This one, let's see. I don't know that they've tapped it yet. No, not yet. At least not that I see right there. We had RNA. This one put in a big move earlier in the week, and I was wondering whether or not we were going to see a an announcement of an offering. So this stock goes from $10 up to 20, it goes up 100%. Is it a recent reverse split? In this case, no, it's not. But they've got a shelf registration, and here's the proposed offering up to $150 million. So, again, as a retail trader, there's a lot of risk for sure, whether you're long or short. Because one of the problems with people who are just, shorting all these stocks and thinking they're just going to keep dropping, is that you can have these periods where you have the squeeze, where you have really high levels of short interest and the stock's super beaten up. And then all of a sudden, over the course of a week, it goes up 300, 400, 500, or 1,000%. And so unless you have been in for a long time, that's a spot where short sellers can get squeezed out. And so, a lot of day traders and retail traders, we're just kind of scraping the market for a little profit here, a little profit there. And these periods of volatility can certainly provide some really good opportunities. So just because it's true that a lot of reverse splits will coincide with secondary offerings and the stocks will decline over time, for short periods of time, for the sake of a day trade, these do present opportunities. It's just important to be aware of the risk. And so one of the things that I'm thinking about, especially with these types of stocks, is exposure risk, which is the amount of time you're holding the stock. Because if you're holding it when the news drops of the offering, you don't want that to happen. And I've been super close. My closest one was actually this year. I was in a trade within minutes. I was in and out, just taking a quick day trade. Excuse me. Within minutes of the secondary offering. And I mean, it dropped just so fast. So I'm usually pretty good at being able to anticipate when there's going to be higher risk of a secondary offering. Usually day one, when the news first comes out and the stock is moving up, usually I'm okay. Day two, day three, if there's not any more news, but the stock is still going up, that's when I start to get a little bit nervous. And there's some people out there, that are really skeptical of these small cap companies, and they believe that the companies or people out there, big investment banks, are actually bidding the stock up almost to bait retail traders to buy into it, knowing that they're going to do this offering. Is that true? I don't know that there's any actual proof of that. I haven't seen any example that I would be like, could reference that actually happened with that particular stock. But it certainly seems, I suppose, what lends itself to the possibility that maybe that has happened before are the fact that, you see these stocks that have these big bids and they just keep moving higher, moving higher, moving higher. And it feels like there's a big trader out there that's walking it up. Is that a short seller covering? Maybe. Is it someone buying who genuinely loves the stock and wants to buy a ton of shares? Maybe. Is it something else? Maybe. We don't know. There was that old episode of The Street where Jim Cramer was talking about hedge funds and how some hedge funds, I don't know at what point, they would buy up stock. They would basically take a certain amount of capital to bid up a stock, knowing that would bring in liquidity, and then they would short into the liquidity with really big size. So it's like they would sort of bid it up to bait people into it and then walk it back down on the other side, which is, this is the type of stuff that unfortunately happens in the market. And it makes trading, which is already difficult and risky, it makes it feel, sometimes you can feel a bit defeated that, wow, there are so many elements of the market where it feels the cards are stacked against us as retail traders. Is there any way that I'll ever be able to find any degree of success? And my feeling is that what's worked best for me, of course, has been focusing on these small little windows where we do have volatility, where we have liquidity, and where I can get in and out and just trade the range. And I do not hold and hope. I do not get married to these stocks and just become a bag holder holding forever. I always try to encourage people, and this is my approach, is I cut my losses. I let it go. And I've had some big losses. Many of you have probably seen. And on some of those losses, the stock did end up going back up, days or weeks later. And maybe if I just held it, the loss would have gone away. But there's been enough other times where the stock kept going lower. So you can't really control how much you'll make, but you can, to a certain extent, control your downside and how much you're willing to lose. So when you're trading reverse split stocks, and certainly stocks that have shelf registrations where you're concerned about the likelihood of a secondary offering, naturally you want to mitigate the higher risk on that in some way, whether it's by trading for very short periods of time or smaller share size, whatever you feel is appropriate. I sort of do a little bit of both personally. But yeah, I saw we had this move yesterday on COSM, which was a reverse split. But this one was just an example of an absolutely insane move where we had the split and the stock actually dropped about 98%, lost 98% of its value before rallying back up. This is a specific instance of what seemed like an oversight in the market making and broker dealer side of the business. The reverse split took effect on the exchanges, but that wasn't kind of propagated all the way through the market. So unfortunately, this created a bit of an anomaly of something I haven't seen before. If you're interested in this particular example, I'll put a link at the end of this episode where you could check that out. But when you're talking about reverse splits in general, this is nothing new. Some of these charts are going to be old. These are all examples of reverse splits. And recent IPO breakout is another interesting setup, but it's something that we see again and again and again. So I think it's good to be aware of it. It's good to educate yourself on it. As always, I want you to remember that trading is risky. My results are not typical, so you should make sure you trade cautiously and practice in a simulator before you put real money on the line. And don't try to blindly follow me or anyone else, right? Manage your risk. So check out that episode on COSM if you want to learn a little bit more about that specific example of reverse split. I think you guys will enjoy it. And thanks as always for tuning in for this episode on reverse splits and secondary offerings.